loading.
The Hangout on air is live. Testing, 1, 2, 3, testing.
The black screen so far.
Maybe it's black until the time that it's supposed to go live.
I can see you on YouTube. Meaning if I copy the YouTube URL, then I can see it.
Okay. So I think that maybe we should go off Skype just to get bandwidth.
Yeah. I see you on the live event. It's maybe just a bit more delay. Huh, cool. That one is.
Ready? So Alex, I'm going to go off Skype.
Do that.
Turn off my phone. All right, looks like we are live. We are live, waiting for some people to arrive. I'm Andrew Stotz, the author of the book, You Won't Get Rich in the Stock Market Until You Change the Way You Think About It. So we have a little Google Hangouts on air to discuss about the book, and I'll tell you a little bit about it. And then after that, we will, let me just turn down my sound here. Oops. All right. So we'll wait just for a minute for some people to get on. Just a moment. All right, we're getting some viewers on. Just give it a couple minutes. We're getting some more viewers on. And I got to get my comments showing. Just testing this out. Just a couple minutes and we're going to get started. Got a few more people to get in. I've got my colleague Alex, who's also on this hangout. So he's going to be, occasionally you'll see me looking down here because Alex is sending me some messages just to get me going, and also any questions and feedback that I see. So let me just talk to Alex, and before that, after that, we're gonna get on. Let's see what Alex says. All right, so why don't we get started? My name's Andrew Stotz, and I wrote the book, You Won't Get Rich in the Stock Market Until You Change the Way You Think About It. And this book basically came from my nieces. I have 5 nieces who, when they graduated from high school, I wanted to teach them how to invest their own money so that they could rely on themselves. Unfortunately, their mother passed away, my sister, when she was about 39. So I really wanted them to be able to look after themselves. And so I've been working in the financial industry for 20-some years. It should be easy to tell them how to invest their money. But actually, it's very complicated. Look behind me. You see all those books? The books on this side are mainly books about finance and investing, a little bit of fitness, a little bit of history, biography, but a lot of books on finance and investing that I read and that I've learned about. I've taught finance. I've worked in finance. And it's a lot of information, and it can be very, very complicated. And I had another major problem, which is my nieces are not interested at all in finance and investing and all of that. So I really needed to bring it down to all this information down to the most simplest that I could come up with. And that was the objective of the book. And so with that objective, I was able to make a book that's under 100 pages, and you could probably read it in about 3 hours or so or less. And the book basically outlines as simple as I can get about it. So maybe what I'll do is I'll go through some of the concepts that I've put into the book so you understand what I talk about. So the first thing is that there's 12 steps, and these came really by me just mapping out everything that I wanted to tell my nieces. It wasn't because I picked 12 for some particular reason. So, and the first step is really to create a written plan and follow it. Sounds pretty simple, but most people don't have a written plan. And as a result of that, they get lost, they get confused, they get off track. They don't know where they're going at all. And the other thing is about it is I say to keep it simple. So I'm going to show you an example of what I mean by simple. One second. I like to tell you can do it on an index card. So here's a little index card, and we could do a financial plan on an index card, which is what I do in my seminars. Now, the second is simplicity beats complexity. A complicated strategy for any to be followed. My nieces won't follow it. They'll get confused, disinterested. Now, in that section and in that chapter, I talk also about the concept of diversification. And if somebody wants to own individual stocks, that person should own no less than 10. Now, most people won't want to own individual stocks. They probably should be owning a mutual fund of some sort. But if you own individual stocks, a lot of people, they have way too few stocks, 3 or 4 or 5, right? And basically what you see is that most people, then they ask me as an analyst, they say, what's your #1 stock that you recommend? Which of course, I don't want to give advice to buy one crazy. So from an equity perspective, investing in the stock market, you want to have a diversified portfolio. And for my nieces who don't really have time, buying 10 stocks is already very, very hard. In fact, it's a full-time job to successfully buy 10 stocks. Now, step number 3 is about starting early, because time really is money. And in fact, I say that you won't get rich in the stock market until you change the way you think about it. This is, once you change the way you think about it, you realize that it's time. Time is the thing that we can get rich from. And that's basically leaving the money into the stock market for a long, long time. And when someone comes to me at the age of 50 or 60 and says they haven't saved anything and they need to save money quickly and invest quickly, how do they do that? Well, there is no quick way to make money. I mean, you could be lucky, but that's like going into a casino and going, look, I really need the money. So I just want to win. You may, but you may not. The next one is to be realistic. This is number 4, to be realistic about stock market returns. The stock market over a long period of time returns about 8 to 10%, and I recommend that people think about 8%. And once you've gotten grounded in that, you realize that when you earn a really high return, like right now, China A shares are up by 150%. You earn a really high return, you realize you've just probably earned the amount that you're going to earn over the next few years just came from that. The next step, step 5, is do it yourself. Pros don't always work for you, and basically in that case, what I'm saying is that you're going to be investing for your investment horizon, which is from your age today. Let's say you're 20 and you want to retire when you're 60. That's 40 years investment horizon. And then you're going to have a retirement horizon. Let's say you're going to live from retirement of 60 to be 90. That's 30 years. That's 40 plus 30. That's 70 years. So no financial advisor is going to be with you over the whole time. And so you're going to have to take care of it yourself. In addition, professionals tend to charge a lot, and fees are very damaging when it comes to investing. The next step is step 6, which is youthful mistakes hurt more than you think. People always say, you know, make your mistakes when you're young, but my point is that when you're young, if you make a mistake and you lose your money, that money is not compounding for you. So a $10,000 mistake could actually mean that you're losing $60,000 20, 30 years from now. Number 7 is start building wealth through savings. There's simply no other way to build wealth on a day-by-day, month-by-month basis than to have your income here and your cost here. And the difference is how much you can save every single month. But most people have, a lot of people, let's say, have their income here and their cost there, meaning they're actually borrowing money from a credit card or whatever. And there's just no way you're going to be able to save and invest. So you need to get your cost down and your income up. And of course, bringing your cost down has its limits. You have to eat, you have to live somewhere. But bringing your income up is unlimited, right? So step number 8 is keeping your financial cost as low as possible. And basically, particularly in Asia where I'm living, the cost of financial transactions and mutual funds, of all of these things, can be really high. So it's your responsibility to know exactly what fees you're paying, and it's the obligation of an ethical financial advisor or a mutual fund company that's selling a mutual fund. It's their obligation to explain fees to you as simply and as clearly as possible so that you understand it. You don't understand it, you need to ask them. Now, number 9 is to diversify to reduce the risk of loss. And what this means is basically diversify. I originally said 10 stocks, if you were picking stocks, is the minimum that you should hold. But the reality is that if one stock goes down or collapses or goes to 0, you would lose 10% of your money. But if you had money in 100 stocks, you'd only lose 1% of your money if you had 100 stocks and one went to 0. And so for most people, they should be diversifying into an index fund, which is the total market. And that keeps it simple, particularly for my nieces, because it's not important so much about what they're investing in, as long as they're not investing in, they're not exposing themselves to a lot of risk. What's important is that they start investing as early as possible. Number 10 is a mix of stocks and bonds is vital. What I explained is that if owning stocks in your portfolio of 10 stocks, a minimum, but maybe 100 or a whole market through an ETF or a fund, then if that's your seatbelt, then blending in bonds into your portfolio is your airbag. And my recommendation is it's about 110 minus your age. So if you're 20, that means that you should be saying 110 minus 20, that's 90% of your money should be in equity. That's simple, and I would recommend that you change it once a decade. Step number 11 is do not trade too much. basically reduce action. Less is more. I talk about some studies in the book about investors that are trading too much, and what ends up happening is they earn a lower return, even though it looks really impressive that they're trading in and out. And finally, step number 12 is cool heads win in the end. So what I mean by this is that try to stay cool. The idea is that stocks, individual stocks, can collapse. They can even go to zero. And so they don't always bounce back, but the market will bounce back over time. Of course, that doesn't mean you just race into the market, you know, when it's up, like China's up a lot right now. You don't want to just race into it. But if you're saving on a regular basis, you're not racing into the market anyways. You're putting market in each month, or you're putting money in the market each month. So don't try to time the market too much by getting in and out. The fact is, what's most important is building a discipline of investing over a long period of time. So those are the 12 principles that I talk about in the book, and I'm happy to take any questions and talk about any other topics that might be out there. So let me just check in with Alex and see if we've got any questions. And you feel free to submit your questions now. Checking them out, so just wait. So you can send an email or you can post on the Facebook if you have any questions. So I'll check. One of the questions that's come in is about what do I advise them to invest in, individual stocks or a portfolio of stocks? And Alex is telling me to check one other place. So let me just pull that up. 1 second. Let's see. I don't think I have that one. So we're going to have to see if Alex can get any of those questions coming in. He asked me to check somewhere. All right. So my advice is that you probably shouldn't be buying individual stocks. You should buy a mutual fund, and in particular, a passive mutual fund that owns all stocks in the market. You could also do an ETF, and an ETF is similar. So you have a passive mutual fund that owns, let's say, all the stocks in the market. And then an ETF is just another way of investing in the same underlying stocks. And so an ETF is just another instrument, but it owns the same underlying stocks. Now, funds and ETFs, they tend to be narrowly focused, like maybe it's a dividend fund, or maybe it's an emerging market fund. My goal for my nieces, and it's easier in the US because my nieces have access to the most competitive financial environment in the world. They can buy an ETF or a fund. In their case, they're going to buy a fund because an ETF is traded like a stock. And you may have a minimum charge. Let's say you have $100 my nieces want to invest in 1 month. And they may say it's a minimum $10 charge for every transaction. So that would mean that they just lost 10% of their money by buying, you know, 1 or 2 ETFs. So it's better for my nieces to just put their money into the fund. In their case, they have a Vanguard, but you have Fidelity and a couple of others. And then they put their money in a fund, and then the fund then invests that money for them. So they're not buying individual shares in the stock market. So that's what I advise for them. In Asia, it's a little bit difficult because some of the markets in Asia can be really expensive for mutual funds, where they just don't have any passive funds. And so in that case, if someone wanted to pick stocks, it may actually be better for them in the long run because there's a lot less fees, because brokers' commissions are very, very low. So that's the idea, and I would say own a fund as much as you can. And if you think that you want to pick stocks, I would say own a fund as your core way of investing, and then take 10%. Take 10% money and invest it in stocks. So another question's come in: where do I get an ETF? And basically, the way that ETFs work is that you just call your broker, And instead of saying, I want to buy stock ABC, I want to buy IBM, I want to buy Apple, I want to buy Petronas, I want to buy CNOC, whatever that company is, with an ETF, you say, I want to buy ETF XYZ. And the broker will execute that just like it was their stock. And that's what makes ETFs really convenient, that you can just buy them through the broker. But when you buy a fund, you have to contact the fund management company, give money to them into your account there, and then they invest that into the fund that you want them to invest that in. Let's see. Alex is bringing another one. The other thing I would talk about too, while I'm waiting for that one to come in, is about taxes. In a lot of countries, taxes can be quite high. In some countries, there is no tax on capital gains. So make sure that you're thinking about taxes as an expense. In my niece's case, there could be a 15 to 30% capital gains tax, depending on what they're holding and how long they're holding it. If you had a 30% tax on capital gains, you had 100 in investment, and then you earned 100 on that. 30 of that gain of 100 you have to pay to the government, let's say. And that 30 means it can't compound for you for the next 20, 30 years. So generally with my nieces, I say avoid selling at almost all costs. Your objective actually is to build up a lot of wealth. So another question is, if your method works, why isn't everyone doing it? Okay, so I'll ask you a question then. What are your odds of winning at a casino? 50-50? If it's 50-50, that means the house wins as much as the people that are going to the casino wins. Can't be 50-50. Actually, your odds got to be less than 50, because the difference, if the casino can win 51 or 52 or 55% of the time, that's going to be their profit for operating the casino. So let's say you're going to have a 45% chance of winning in the casino. You like those odds? They're not in your favor. So my question to you is, are the casinos empty? No, because people want to go in the casinos and they want to win. And they want to try to be the one. I want to be the Warren Buffett. I want to be the one that picks the stocks that win. And maybe you will be. But for my nieces, I can't tell them to go into the stock market, as it is, it is based a lot on statistics and let's say the distribution or normal distribution, that the probability is that they're going to have average returns, and there's a real risk also they could lose their money. So to go in and tell them, you can get rich in the stock market, I think is a mistake. So that's the reason why I think many people want to find, it just feels better to be able to say, what's happening with oil? I want to have this exposure, and maybe the US is too high or China's too high, and move things around. It makes sense in your mind, but I can say from 20 years on the inside of the financial industry that generally people don't outperform. In fact, we have great data now and great research reports done in the academic field that show that fund managers on average don't out. If they could pick those things, they would outperform, and that's their full-time job. All right, let's look at another question. How many years does it take until the compounding interest starts to work for you? Can you please also try to explain compounding in simple terms? Okay, so compounding in simple terms is basically, if you put $100 at the bank and you get a 10% interest rate, you're going to get 10 in interest at the end of the year. Now you can take that money and spend it, and now you got 100, and the next year you earn 10%, so you got another 10. Great. Then you take that money and you spend it, and then the next year, the third year, you have 100 in the bank, and then you earn 10, and you decide, I'm going to leave it in. So you leave that money in. How much are you leaving in the bank now? 100 plus a 10, 110. So you're going to earn another 10 on the 100, the first 100, and then you're going to earn 10% on the 10. What's 10% on 100? Well, it's 10, so you're going to get another 10. And what's 10% on the 10? 1. That 1, that little 1, is compound, the interest on interest. And watching that grows exponentially. And so what that means is that after 20 or 30 years, it really flies. In fact, the value of your investment could be as much as 80% of it could be coming from that little component of interest on interest. So next question, Andrew, as you say, passive funds are beneficial because they match the market and have low fees. One may offer 0.25% of total fees, and another fund offers 0.5. So the fee is low at 0.25 and a higher fee of 0.5 for another fund. Are there any special services the expensive fund may offer to make it advantageous over the 20.25, or is the goal solely to diminish fees? Well, okay, so with a passive fund, you can get, let's say, exposure in the US. In Asia, it's different. It's a lot more expensive. It may be 0.5, 0.6 for a passive fund. I've seen some that are quite high. But let's talk about the West for just a moment as an illustration point. Basically, a passive fund is going to cost you about 0.2%. And an actively managed fund, where somebody is trying to pick stocks and outperform the market, is going to cost you probably on average about 1, maybe some additional bonus if they do well, but let's just say 1. So 1% versus 0.2%, it's a huge difference over a long period of time. So are you getting some benefit for that additional amount of 0.8, right? So you pay 0.2 for passive, you pay 1 for active. Are you getting a benefit for that 0.8 additional money? The answer is no. There's no additional service or anything like that. You do get maybe a report every quarter or every year where the fund manager, the stock picker, tells you about what they did that year, and maybe that guy traveled around, he has good pictures, maybe he outperformed, but there's no guarantee that he outperforms. And as I say, on average, he underperforms. And finding the fund manager that outperforms over a long period of time, remember, you're investing for your investment horizon and your time and your retirement horizon. Basically, you're talking about a long time, very few. The probability you can find the person who's outperforming over the long run before they outperform is something like 5 or 10%. So that's that question. Next question is, I have a financial plan in my head. Why does it matter to have it written? Oh, it makes such a big difference to write it out, because it's also helping you. So when bad things happen and you get shaken up or you get off your plan, you can go back to the plan and know exactly what you're doing. So it keeps you focused. Also with the plan, it also helps you to visualize it. You'd be surprised at how unclear the plan in your head may be. And so that's the reason why I advise that. Next question, if everyone can invest on their own, why are there so many financial advisors out there? Well, remember, there's complications, right? There's taxes, there's 401k, there's tax incentive schemes around the world. Those could be issues. There's people need to buy a house. There are legitimate reasons why they're financial advisors, but the main thing is that you just want to keep your costs down as low as possible for those financial advisors. But for my nieces, you know, what do I need from them? What I really want from them is for them to use the power of the stock market to grow their money over a long period of time. They're to buy and never sell for 30 years. If they follow that, they don't need it, because the fund that they own owns everything in the world, and they're blending it in, as I said, 110 minus their age, and then after that. But isn't that exactly the right time to make them, since I have time to make up for them? Okay, one of my good friends called me after he read the book, and he says, I think you've got it wrong. You know, you've got to advise people when they're young to make mistakes, live it up, enjoy life. You know, you can make it up. Well, in the financial world, when you lose money in the beginning, it means it's not compounding for you for a long period of time. And therefore, your $10,000 that you lose may be worth $60,000 30 years from now. So you really lose a lot when you lose money in the beginning. Of course, I say not to make mistakes when you're young, but what I mean by mistakes also is don't postpone investing. That's a huge mistake. And then the next one is try not to make these mistakes. My nieces aren't going to make mistakes. They're going to own every stock in the world, and they're going to contribute to that every single month. It's hard for them to make mistakes with that. Now, the next one. Including you, talks about diversification. I understand that it is reduces risk, but I don't fully understand how it works. Can you explain diversification in simple terms to me? Oh, this is my favorite explanation, and I'm sure you will understand it after this. Imagine that you are a female, and you have a boyfriend, and that boyfriend is a grumpy guy on let's say on Tuesdays and Thursdays. Monday, Wednesday, Friday, he's happy, but on Tuesdays and Thursdays, he's an unhappy guy. You really want to get rid of him on those days. Now, let's just say that you decide you're going to have two boyfriends. You're going to find a new boyfriend. Now, if you found a boyfriend who was unhappy on Tuesday and Thursday also, then you haven't gotten any benefit for getting this boyfriend. You're still unhappy on Tuesday and Thursday. But if you could find a boyfriend that's unhappy or that's happy on Tuesday, Thursday, but he's unhappy on Monday, Wednesday, Friday, he's unhappy even more days. He's higher risk. But when he's happy, it's the days that the other boyfriend, Tuesday, Thursday, that he's unhappy. Now, 5 days a week, you're happy. This is adding two risky assets. Can we say boyfriends are assets? Yeah, let's hope so. You're adding two risky assets, but they act in an opposite way. And as a result, you get happiness every single day, Monday to Friday. And that's the best way I can describe diversification in simple terms, which is sometimes some stocks are going up and others are going down. If you only own one stock, the risk is you own that one that goes down. If you own 10 or 20 or 30 stocks, then what you've got is you've got the chance that when one's down, the other one's up. So that's the concept of diversification. Next question. I have a friend who claims he makes a lot of money in trading currencies. Why don't you trade currencies? Yeah. Somebody said that to me, that they made a lot of money in currencies. I don't know much about currencies, so therefore I don't teach it and write about it in the book. But I know that the average fund manager who's a professional stock picker does not outperform the market over the long run, and that only a small number of them do outperform over a very long period of time. Now, that's the stock market. I would say that the commodity markets, the foreign exchange markets, the interest rate markets, these markets are even bigger than the stock market and much more complex. So it sounds good that they're making money, and maybe they are. You know, are people making money in casinos? Every day. And when somebody makes a lot of money in the casino, then, you know, the casino will do a press release and bring the person up on stage to cheer them on. So what I would say is that I just don't know a lot about currencies, but I know it's hard enough to outperform in the market. I think most people probably, after 1, 2, 3 years, the currency trading system that they found on the internet or whatever maybe works for 6 months or 1 year or 2 years, and then one day they lose it all. So that's a very high risk. Question, how do you manage to stay invested when the stock market crashes? Well, for my nieces, again, over a long period of time, the stock market crash doesn't really matter when you think about it over a 30, 40, 50-year period. In fact, what you should just be doing is just keep buying, keep buying. All that you're buying when the stock market is crashed is stocks that you're buying at a cheap price. Now, it's a little different if you just jumped in the market, it went up 150%, as China has just done. It's a little different. Making 150% gain in the stock market maybe is something worth taking some profit on. But most of the time, it's very hard to know whether the market is crashed high. And look at the last crash in 2008. Nobody saw it coming. It crashed. It was down. Everybody was disaster. And lots of people sold their stocks at that time. And then what happened? It bounced back. Very quickly, it was back to normal. And so you just run a huge risk of losing a lot of money by doing that. Next question, if very few fund managers outperform, why are there so many of them? Sounds a bit strange to me. Well, people like the idea that they can hire someone who is beating the market. People just like that idea, and they're always going to give fund managers money to manage. I mean, it's like I say that the casinos are not empty, even though everybody knows that the house always wins. Are you investing in China A shares now? It seems like it's going very well. Well, for my nieces and in the book, I basically say that you should own every stock in the world. And that way my nieces can say that 150% rise in the China A shares market, you know, I'm getting some benefit of that through my fund that owns every stock in the world. Now, technically, it doesn't own A share stocks, or it owns a small exposure to that through Hong Kong. But the point is that they're going to own stocks. I couldn't hear it very well, but I'm sure they've got some great food on the back of that truck. So what I would say is that if you are investing specifically only in China A shares, that it probably is time to take some of that as profit, because the market has gone up 150%. The PE and the price to book are a bit expensive, and return on equity has been falling. So I would be careful with that. Maybe that's the last question. Let's see. I think I can see Alex send in another one. Hold on. That was a good number of questions. So let's see. Alex is a little bit of a slow typer, I see. Or else he's typing a big, copy pasting, typing a big question. I'm gonna take a drink. Important to drink a lot of water. I drink many cups a day. Okay, somebody asked, aren't I advising myself? My business is advising active fund managers to do active investing. Yeah, my specialty is picking stocks, and I love to pick stocks, and that's what I studied, that's what I taught, that's what I worked in, and that's what I've done all my career. And there's a lot of demand for that. There's a lot of people that still want somebody to pick stocks. And, you know, but when I talk to my nieces, you know, they don't know anything about picking stocks, and I would never advise them to pick stocks. And I wouldn't advise them to try to find a fund that picks stocks, because the probability, as I said, is maybe 5 to 10% that they could find a fund that's actively picking stocks that outperforms over a long period of time. That's way too much complication for my nieces. They need to keep it simple and invest in a passive fund. Of course, in my case, the bulk of my wealth has been in passive, but I also can pick stocks, so I sometimes work with active managers, and I actively manage funds also. But basically, I know a lot about the truth about it, so I'm very, very careful about what I do. But it doesn't mean that I'm going to outperform even over a long period of time. Next question. Do you believe that markets are efficient? I think that they're as efficient as they can be. You've got a lot of people in the market that are trying their best to try to judge what something's worth. And occasionally they go crazy and overpay, and occasionally they go crazy and underpay. So I would say generally the markets are efficient because the average fund manager can outperform. If they were inefficient, then the average fund manager would be outperforming. So in general, I would say that the markets are efficient. Now, if you happen to have a specialty in one tiny little area, it's very possible that you can find an inefficiency. Just because there's an inefficiency in the different pockets of the market, it doesn't mean the overall market's not efficient. It just means that you're capturing the inefficiencies. Some people are takeover. They only look at mergers and acquisitions, and different people look at different things. Next one is, what would you say are the main lessons you've learned throughout finance? Which is, it's the financial professionals are like everybody else. They're just trying their best. They can't see the future, and don't expect that they can, no matter how much they say that they can. Don't rely on them by looking at the TV and all that stuff to try to figure it out. The second lesson I would say in my life is that the people that bought a diversified fund and then went back to their work and didn't think about it probably ended up outperforming the people who were trading a lot in the stock market. And my third lesson from my perspective is that to remember that you don't really get rich in the stock market, you get rich through business. And when you start a good business and you're an entrepreneur, you really get rich. Most people that we see in this world who are rich because of their own business. And the second thing I would say about that is if you're not an entrepreneur, which is most people, then find an entrepreneur and work with them to help them be successful and try to get a piece of that. And I think this may be the last question. Let me see. Have you ever considered to invest in commodities? Which one? I don't advise my nieces in this book to invest in commodities, and I'll tell you why. And for myself, I don't invest in them. Commodities, you know, gold, silver, oil, things like that. First thing is that those things are all inputs to many of the companies around the world. So those companies in the stock market are moving up and down based upon the inputs or outputs that they derive from commodities. So commodities already have an impact on the market, but it's not really an exact impact on the market. Sometimes commodities can go up when the market's going down and vice versa. Now there's less of that nowadays because you've got a huge Chinese market that's a huge consumer of commodities. But what I would say about commodities, the problem about commodities is that usually to own a commodities fund is very expensive. And it could be as much as 1.5% to 2% for that fund. So the diversification benefit that you get probably doesn't offset that additional cost. And that's a major reason why I don't own commodities and don't recommend it. I think this is the last question, Alex. Yeah, it looks like last question. If I want to start to follow your methodology now, what are my first steps? Well, let's say you don't have a lot of money. I would say that your first step really is to probably go out and open up a bank account. And so open up a brand new bank account and start putting in monthly contributions of $50, $100, whatever it is you can, and start a discipline of saving. And that would be the thing that I would say is probably the way that you could start on Monday. Now, if you had a big chunk of money and you decided that you wanted to start following my methodology, then I would suggest that depending on the amount that you have, what I would suggest is that you consider an ETF, a passively managed ETF in your own market. Now, it's going to be different than other markets. If you want, you can send me an email and or a message, and you can keep in touch, and I can try to help you to look at that. I haven't looked at all markets around Asia, for instance, but that's the one way I would start. And then, okay, so there's another question that came in. Let's look at that one for a second. It says, would you consider technical analysis more important when it comes to day trading? The truth is, I don't know much about day trading. I've never done that, and I think my nieces would go crazy if I told them, hey, you need to day trade. That's how you're going to make money in the stock market. So the book is not focused on day trading, and I just don't know much about it. Now, I know a lot of people, a lot like the casino, that they may win 1 year, 2 years, 3 years, but you really, really, really got to have a lot of skills and success in that to offset the costs related to all the trading activity. So I don't do a lot of it, but if you were doing day trading, you're going to be analyzing mainly, and some people may be doing it about the news flow or something like that, but mainly it's going to be share price, whether you like the way the share price is moving and all that. But generally, I would advise my nieces never to get into that. I think that is the last question, and I just wanted to remind you that if you scroll down at the bottom of the webinar page, which you should be able to see there, you'll see a link. If you click on that link, you'll see my book is available on Amazon. And right now, for only a few more days, it's going to be there at 99 cents, just $1. So you can read the book in about 3 hours, and it should be able to give you a lot more detail than what I've given here. And I'd certainly welcome you to join any dialogue there to discuss anything more about it. So I think I want to thank everybody for attending, and thanks for your questions. That was a lot of good questions, so I appreciate it very much. And submit any questions that you got, and let's keep the dialogue going. Thanks.